Hello, it's Jeffrey Christian. It's about 10:50 on the morning of the 8th of November, Tuesday, Election Day in the United States. I wanted to talk today about the real silver market. There's some strange things. I guess there are always some strange things that go on that are said about the silver market and about other things too. I saw a very funny headline today. It said, Democrats are out of touch with the American voters. And I thought, is that really news? Anyway, neither here nor there. I'm not supposed to be snarky about people who think that there's something sinister about the fact that I have notes that I referred to and things like that. But let's talk about silver. First off, a little bit of a market update. Gold and silver prices have been bouncing around. They seem to be forming a base, but there's a lot of risks in the financial markets that could still come home to roost. So we have to sort of see how it shakes out. There is still downside risk to gold and silver because there's a lot of uncertainties in the political environment as well as the economic environment and the financial market stabilities. So we are where we have been for several weeks, and we're probably going to continue to be that way. It'll be interesting to see how the election results come down in the United States today. We've been assured that it'll be weeks before some of the key votes are decided. So we'll just see how that uncertainty factors into financial markets. But let's talk about the silver market. The fundamentals of the silver market and the four main segments of the silver market that we divide the market up into. We look at total supply, which is mine production and secondary recovery. There are people who think there's a lot of government inventories left in the world. Most of them were sold off in the 60s, 70s, 80s, and have been gone for a long period of time. It's mostly secondary recovery of scrap and total and mine production. Fabrication demand, silver that's actually used in manufactured products that have a value added to them beyond the value of the silver. Investment demand, silver that is bought as an investment or a form of savings, and it retains its essence as silver. So it's bullion, bars, coins, medallions, rounds, and then inventories. Inventories are an important part. Now, I've got a lot of charts here today. It's going to be a little bit longer than usual. Charts on slides 5 and 6 are from our Silver Yearbook, which came out earlier this year and has a lot of basic data. Our Silver Yearbooks really are an outgrowth. They started off as the J. Ahrens Silver Review and Outlook in the late 60s, early 70s. They continued through Ahrens. After we were bought by Goldman Sachs, they became our Commodity Market Perspective. And then in 1986, when CPM Group spun out of Goldman Sachs, we started calling them the Silver Surveys and changed it to Silver Yearbook around 2005. They've been around. All of the other charts pretty much are from CPM Group's November Precious Metals Advisory, which is our monthly report. And then there are 4 slides that I used last week that I'm going to repeat because they bear repeating, and people have let me know that they really didn't understand what I was talking about. So the price of silver is determined by the interplay between silver's fundamentals and investment demand. And investment demand is a fundamental. But when I say silver's fundamentals, I mean the balance between total supply and fabrication demand. That's Commodities 101. There are people who will smudge this because they want to make a bullish view, and they'll add some investment demand or some estimates of investment demand in with fabrication demand. And then they can say the silver market's in a deficit, so you should be buying silver because the price is going to skyrocket. But commodities research done well and properly looks at total supply less fabrication demand. Investors ought to want to know whether a market is tight or loose, well supplied or shortly supplied, in short supply, based on the fundamental use by manufacturers who need the metal. You know, a silver market that's in deficit because investors are pouring into the market is far less of a secure investment than a silver market that's in a deficit because fabricators who need to use it in their products are using it. So that's the way commodities research done well is done. And it's very funny because you can find banks that will have a commodities research book and they will have that methodology across commodities except for gold and silver and platinum because they're using data from marketing groups that smudge the data to show tighter markets to make investors think that they should be buying this metal necessarily. You look at the interplay between that supply and demand, fabrication demand balance, and you say, what's there? Yeah, if it's more than investors want in any given period of time, the price will fall. If it's less than what investors want, the price will rise. And investors are the prime mover here. It's not that investors absorb what's left over for them. Investors decide how much metal they want, and they bid the price higher or lower, leaving the rest for the manufacturers. From 1990 to 2005, investors as a group were net sellers of silver. I think, well over 1 billion ounces, maybe almost 2 billion ounces of silver was sold by investors in that 15-year period because they were disenchanted with the price of silver, which was basically flatlining between $350 and $550 at that time. They became net buyers 2005, 2006, and they drove the price much higher by buying silver and bidding it away from manufacturers and encouraging increased mine production and increased secondary recovery through higher prices. So that investors are not passive takers of metal. Investors are really the people who set the price of silver. And there's any discussion about, oh, well, that's a paper silver price versus a physical silver price. No, the paper silver price and the physical silver price are pretty much there. And if you want to look at what the paper silver price for a 1,000-ounce bar is, and you want to look at what the physical price of a 1,000-ounce silver bar is, it's about 6 or 7% higher today than the paper price, if you will. So the real price is, in fact, aligned with the paper price. And people who talk about the paper price are basically demonstrating a fundamental lack of knowledge about the silver market. Or maybe they know about it and they just want to mislead investors into buying silver. Now, there are higher prices for smaller units, but that's like saying, well, the cocoa price on the exchange for a ton of cocoa is $1,200 a ton. But if I go to the grocery store and I want to buy a can of cocoa, it's $6 for 8 ounces. And that comes out to be $60,000 or whatever it comes out to per ton. So there's a distinction between the real price and the exchange price. No, you're talking about wholesale on the exchange, and you're talking about retail in the grocery store. You're talking about wholesale silver on the exchange or in the over-the-counter market. And you're talking about retail when you're talking about prices for coins and medallions. Mine production is off slightly from its 2016 peak, but it's basically been bumping along over the last few years. There was a spike down in 2020 during the pandemic. We've come back and we're kind of around the same level that we were at 2019. Total supply, which includes secondary recovery from scrap, old scrap, not new processed scrap, but older scrap that's gone into the world as manufactured product and has come back out to have the silver recovered. That also is pretty much flat over the last several years, down a little bit from its peak in the mid-teens, 20 teens. You can see some exports from transitional economies back in the late days of the Soviet Union, and China was involved there too. And you can also see government disposals. There was a lot of silver, about 1 billion ounces of silver that came out of China in the period from the late 90s into the early aughts. And some people mistakenly think that that was actually government inventories. In fact, that was silver, along with a bunch of gold, that was refined in China by base metal smelters and refineries that wanted the copper, the lead, and the zinc. And they were importing ores, base metals or concentrates that had silver and gold in it. And this was when the Communist Party in China and the Communist government in China still controlled and were the national market maker for silver and gold prices within China. And in order to allow the smelters to do that, there was an arrangement made that the smelters agreed to sell their gold and silver for export as they refined it. They were coming for the base metals, copper, lead, and zinc. They couldn't compete in international tenders for base metals concentrates because they couldn't bid the full price of the gold and silver byproducts. So we created this mechanism to allow that. And the Chinese government said, okay, that's acceptable. And then the gold and silver were exported. And there was a lot of gold and silver that came out at that time. And some people didn't realize or they weren't part of the system, thought that this must be government sales. It wasn't government sales. It was metal that we measured as mine production outside of China. And so we didn't double count it by also measuring it as refined production in China or net exports from transitional economies or government disposals, because it was none of that. But total supply, relatively flat. We have it coming down over the next few years modestly. It's not falling off a cliff the way some people seem to think. Fabrication demand also has been relatively flat over the last few years. You can see some variations. And one of the interesting things that's popping up right now is photo, that green stuff at the bottom that used to be the largest use of silver. Photo is actually coming back a little bit this year because there is not exactly nostalgia. I think it's a desire for higher quality prints, and people are using more film and paper. And some of the photo product manufacturers are actually increasing, they're hiring people to increase their production of silver-bearing films and papers because there is a small group of people who take pictures who want a higher quality all of a sudden. Two key sectors to look at. On the left hand are solar panels. We've seen increases. Our expectations that we'll see a further increase this year in silver use in solar panels. It's a trend that's been going on for about 15 years, and it's going to continue for the foreseeable future. In the long run, at some point, you're going to start seeing silver recovered from end-of-life solar panels, and that will reduce the demand for new silver growth rates. But the total demand for new silver probably will continue to increase in volume terms because solar panels will continue to increase. And in silver use in the auto industry, you can see it's risen sharply, say, from the turn of the century into about 2018. It's come down and it's relatively lower now because of constrictions in the auto market. And it has to be pointed out again that this is silver used in petroleum-based ICE engined vehicles. This is silver that is being used in increased volumes, sharply increased volumes, because of the increased use of electronics in the silver, in the automotive sector with all the gadgetry that's been being put on there. Electric vehicles will probably use 1.5 to 2 times as much silver as a petroleum fueled vehicle going presently. At present, we have about 8 or 10% of the auto production now electric vehicles, and they use about 1.5 to twice as much silver as a conventional vehicle. It's not 6 times or 10 times the way you'll hear from silver promoters. Investment demand, as I said, these are the guys who really sit on top of the silver price. And you've seen some investors selling physical silver this year. In the ETFs, which happen to be physical silver backed, we don't measure the ones that are not. We don't include those that are not that they're not using allocated physical silver. We don't include those. Those that do use physical silver, we've seen more than 100 million ounces of net sales so far this year through October. That's physical silver that's being sold by investors, some of whom are disenchanted with the silver price and the silver market over the last 10 months. Some investors have been selling silver futures. On the left-hand side, you have gross non-commercial, gross long and short, and net silver positions on the Comex futures and options markets. And you can see the black line, which is the net, has come down. For most of the time, this goes back to 2014, but you can take this data back to the mid-1990s. You can see that most of the time, investors have been net long silver. And you can see there was a period of time around 2017, 2018 when they went negative. And there was a lot of investors who were actually shorting silver. And the price of silver reflected that, falling sharply at that period of time. Since that time, investors came back. They were net long, 350 million ounces or so at times on a gross basis, 250 million ounces on a net basis. But over the course of this year, they've actually started being net short again. Again, disenchantment with the price of silver. The right-hand side is commercial gross long and short and net positions. And there are people who have been saying, well, the banks must know something because they're going long. But these commercials basically are the people who sell short when investors want to go long and go long when investors want to go short. So if it looks like pretty much a mirror image, that's because it is. It's not that the commercials, the banks and trading companies and futures brokers and floor brokers, well, there's no floor anymore. It's not that they see something coming and they expect the price of silver to rise. It's that they see that their customers are net sellers and want to be short right now. And that means that they have to go net long. And of course, they hedge their own positions because they're intelligent market participants. Some investors have been paying very high premia for silver coins. And this goes back to my cocoa analogy. Yeah, you're paying 80% for the silver eagle because there's a shortage of them and because people want 1 ounce coins. If you look at the silver 100 ounce bars, yes, the premiums are much higher than they used to be, but they haven't risen as much as they have there. And then again, if you look at 1,000 ounce bars, which are the good delivery wholesale size, the premiums have risen and they're up to about 6 or 7% right now. Inventories and markets. London inventories came out today for October. They were off another 2.2%. They're down about around 850 million ounces from a peak of around 1,175,000 ounces. At least a third of that actually represents the ETF sales. Another portion of it, which we don't have data on because the data is not public, probably represents ETFs that some banks held, and investment banks, commercial banks, and brokerage houses that had been holding silver for a few years, and they had transferred from bullion to ETFs. And they've probably been selling some more of their ETFs over the last several months. So inventories are down in London. Inventories are kind of lower from where they were 2 years ago in Shanghai, and they're relatively flat. You're hearing people talk about the metal pouring into the Shanghai market. And there is metal moving into Shanghai, just as there's metal moving into New York and North America, into Canada and the United States to meet both fabrication demand and investment demand. So there is metal moving into Shanghai, but you can see here that the Shanghai Futures Exchange inventories actually are not rising. Sorry for those people who believe that. Sorry for those people who keep telling you to believe it. Now, this is Shanghai Futures Exchange silver trading volume on the left, silver trading open interest on the right. And I'm showing it to you just again to see that there's not been a surge in trading and there's not a surge of open interest in the Shanghai futures market. And I want to clarify something else that gets misrepresented in the market sometimes. The Chinese silver market has a higher delivery rate through the Shanghai futures market than you see in the United States and Europe in futures contracts, not just in silver, but in other commodities too. There's a greater use of futures markets and futures exchanges by fabricators to take delivery of silver and other metals through them. That represents a couple things. Primarily, it represents the government saying, we want to better monitor, excuse my typographic error there, we want to better monitor who's buying silver and who's using it. That's what centrally planned economies, i.e. communist governments, but not just communists, fascists and Nazis do it too, other people. That's what a centrally planned government does. They say, we want you to buy all of your silver through the exchange so we know exactly how much you're buying. And then we're going to assume that you're using it until we stop assuming that because we've learned something else. But we want to know who's buying it. That's why you have a greater delivery on the Shanghai exchange. So those are people who say, well, gee, if we were like China, well, if we were like China, we'd be a communist country. Duh. I want to go back. These are 4 slides that I used last week explaining the relationship between silver, Comex inventories in particular, and their relationship to silver prices. And again, it's just something that's been misrepresented. Comex inventories have come down. They've come down from very high levels that they rose to in the period 2017 to 2020. They are back down in the case of registered stocks to the level that is pretty much consistent with what they've been for most of the period from, say, 1999 until 2017, 2018. And then in terms of total reported stocks, eligible as well as registered, they've come down, but they're still at higher levels than they've ever been prior to 2018 by a wide margin. You can see from 1998 to 2012, when the price went from $5 to $50, total inventories were about 100 million ounces and registered stocks were about 30 million ounces. Registered stocks are about 35 million ounces now, and total stocks are around 300 million ounces. So they're probably, let's just say 3 times as much as they used to be. Not really running out of silver there. These are just the registered stocks. This is the relationship between the total stocks and silver prices. And you can see silver prices don't rise when stocks are falling. They do rise when stocks are rising sometimes. They do rise when stocks are flat. The relationship just doesn't exist. So those guys who keep telling you that the Comex is going to run out of silver and the price is going to rise in biblical proportions, there's no basis in historical fact for those statements. And the same is true, even more so when you just look at registered silver inventories. I want to look at one last chart, silver lease rates, because again, you're hearing, oh, silver lease rates are skyrocketing because the world's running out of silver. No, silver lease rates are rising, as are lease rates for most metals that are lent out, because interest rates are rising. Costs more to borrow the money to buy the metal, to lease it out to fabricators and other people who want to borrow metal. So you pass that on. There's a problem with lease rates, as with forward rates. There's no such thing as a forward rate price for gold, there's no such thing as the forward price for gold, and there's no such thing as the silver lease rate. That's because both the forward price and this lease rate depends on who's borrowing or buying or selling. If I'm a bullion bank, and I'm not, but if a bullion bank has several clients, and one is a central bank, the forward rate's going to be different than if it's a major mining company or a jewelry fabricator or an institutional investor. Same is true with the lease rate. You want to know how much somebody's going to charge you to borrow silver? Ask him. And he's going to look at your credit worthiness. And that's where that lease rate comes from. The lease rate basically represents an interest rate, the forward spread in the underlying commodity, and a risk premium. And the risk premium itself includes various things, including market risk, price volatility, and credit risk for the borrower. Now, there are people who will come up with implied lease rates. And you can see here's one that I grabbed off the internet. There's a large period of time with zero or negative silver lease rates. No one actually pays anyone to borrow silver from them. There's no such thing as a negative metals lease rate. And we've seen this with gold and silver and platinum and palladium, where people will calculate implied lease rates. And in fact, our gold, silver yearbooks and maybe our platinum group metals yearbooks have implied lease rate charts there. But we explain these are just indicative, and they're not indicative of what happens in the market. There's always a positive rate. There's a group that used to publish forward rates and lease rates for the London market, and we used to get calls from clients and institutional investors and mining companies and high net worth individual investors and fabricators that say, I'm looking and I see these charts that say that the London lease rate for gold is, negative 2%. I would like to borrow gold and have somebody pay me 2% for it. Can you help us arrange that, Jeff? And I would say no, because that's an implied lease rate. It's not a real or actual lease rate. So lease rates are rising because interest rates are rising and because the uncertainties surrounding everything in the world are rising. That risk premium. And beware of people who use implied lease rates to talk about what's really going on in the market. It's a lot of heavy-duty information there. Basic information that you can read in our Silver Yearbook, which you can buy online at our website. Sorry it took a longer time to talk about, but if you really want to understand something, you have to study. Or as Dan Aykroyd said to Bill Murray in Ghostbusters, you never studied, did you? You have to study this stuff to really know it. And if you're going to speak intelligently and accurately, you really need to know it. You can always sound intelligent even if you're not. Have a good day. Take care of yourself. Take care of everybody around you. Watch out for the aftermath of the U.S. election. And we'll see you later in the week.